to my channel. I'm Scott, and if you want to catch my newest video, I post one every day at 8 a.m. In this video, I'm going to walk you through the process of valuing Alibaba's stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Alibaba is every baby's first stock. Baba, that's the ticker. This company is a Chinese version of Amazon. It was founded in 1999, and its IPO raised $25 billion, giving the company a market cap of $231 billion, making it the largest IPO ever. Let's get started with the model. This is a large cap company, 601 billion market cap. They're trading at $256 a share, and they have 2.7 billion shares outstanding. Let's look at their financials. All their financials are reported in Chinese yuan, but all the numbers on my Excel spreadsheet are converted from yuan to US dollars. The way you value a company is you forecast their future free cash flows, and then you discount that number back to today's value. That's what we're doing in this video. And their free cash flows grew from 9.4 billion in 2017 up to 20 billion in 2020. Net income is the profit and loss on the income statement. It's revenue minus expenses. And their net income more than tripled from 2017, 6.5 billion, to 2020, 22 billion. Revenue is a sales for the company, and that also grows at a rapid pace, 23 billion to 76 billion. This is the company's income statement, and these numbers are in yuan, but if you wanted to look at them in US dollars, just divide by 7. The top line is the revenue, the sales. Below that is the cost of revenue. And the difference between those two numbers is the gross profit. So you can see the company's gross profit more than doubles from 2017 to 2020. They also have operating expenses. Then below that is operating income. And that is also growing every single year. Below operating income is the interest the company receives on its investments minus the interest it pays on its debt. So it actually has $68 billion of interest income. So the company's pre-tax income is 166 billion yuan. They had 20 billion in taxes, and their net income is 149 billion yuan. That's a huge increase from 2019. So the income statement looks really strong. This is their statement of cash flows. The top line is operating cash flow, and then capital expenditures are investments in property, plant, and equipment. And the way you calculate free cash flow, it's operating cash flow minus capex. And they have a ton of free cash flow every year, 135 billion. And it more than doubled since 2017. The company did issue a lot of stock in 2020, 91 billion yuan. And it seems to be issuing more debt than it's paying down. It issued 97 billion in 2017, paid down 67 billion. It issued 72 billion in 2018, paid down 39 billion. But it did pay off more debt in 2019 and 20 than it issued. But the company is generating so much free cash flow, I wouldn't worry too much about the debt and equity issuance. And when you invest in a company, you want to make sure they have positive operating cash flow, or at least the potential to have positive operating cash flow. And this company definitely does. It goes from 80 billion to 180 billion. And the way you calculate operating cash flow, it's net income, which was 140 billion, and then you have to add back the non-cash items on the income statement. You have to add back $42 billion of depreciation, but they reported a $72 billion non-cash gain, so you have to reverse that out on the statement of cash flows. Then we have to add 31 billion of stock-based compensation. We also have to add $21 billion of working capital. So the company's operating with tons of cash flow. It's doing really well. Let's look at a capital structure. $130 billion of equity, 22 billion of debt, and their net debt is negative 32 billion. So they have enough cash in their balance sheet to pay down their entire debt and still have $32 billion of cash left over. They pay 3.5% interest on their debt, and cost of debt is 2.9%. 14% of their capital structure is debt, so 86% is equity. Cost of equity is 10.2%. And their beta is pretty close to 1, so the stock moves with the market. Their WACC is 9.17%, which is a blend of the cost of debt and cost of equity. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year for, that's $1 trillion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $848 billion. We divide that by 2.7 billion shares. And we get a calculated stock price of $313. They're trading at $256, so they're trading at an 18% discount. It's a buy according to the model. Simply Wall Street is a little lower than me. They're at $297 a share, but they're also saying the stock is undervalued. The stock has gone up pretty steadily the past 5 years, but it did dip the last couple of weeks, especially the last trading day this week. On December 23rd, the stock went down 15% after market trading because the Chinese government accused this company of being a monopoly. The stock has outperformed the S&P 500 up 18% compared to 14%. The 52-week low is 170, the high was 319. The stock is trading below its 50-day moving average and 200-day moving average, so it's on a downtrend. And the company has a pretty high trading volume. About 14 million shares are traded each day. And of the 2.7 billion shares outstanding, 1.85 billion are on float. And about 44% of the shares are held by institutions, and it has a really low short percentage. About 1.5% of the shares are shorted. The stock closed on December 23rd at 256.18, but after hours the stock went down to 222. The reason it went down so much is because Beijing launched an antitrust investigation into Alibaba. Also, the government is looking closer at their financing union Ant Group. The stock went down 13.4% after hours trading, wiping out $100 billion from its market cap. The company's largest shareholders are SoftBank, 24%, BlackRock, 3.4%, Yunma, 2.9%. Yunma is Jack Ma, and then T. Rowe Price, 2.3%, Vanguard, 2.3%. Let's look at their financial ratios. The average PE in the market's 12.3, the median is 14.8. PE is stock price over earnings per share. They're at 31.0, so investors are paying $31 for $1 of earnings. That ratio is worse than the average and median. Price of sales is stock price over sales per share. They're at 9.1. That's also worse than the median and average. Price to book is stock price over book value per share. They're at 5.3, so they're pretty close to the market average. The way you calculate book value per share, that's equity over shares outstanding. Equity is assets minus liabilities on the balance sheet. If they have a lot of intangible assets on their balance sheet, that's the result of all their acquisitions. Interest coverage ratio is EBIT over interest expense, so they can cover their interest payments almost 3 times. ROE is net income over equity. They have a pretty good ROE, 17%. Current ratio is current assets over current liabilities. They're at 1.9, so they can cover their current liabilities. So their largest current asset is cash, 363 billion yuan. This number in this chart right here is in yuan, but everything on the Excel spreadsheet is converted to US dollars. So the company is more than well capitalized. It has $20 billion of free cash flow and $33 billion of working capital. The best way to look at ratios to compare them to similar companies, I've done videos on Momo, JD, Amazon, Chewy, eBay, Etsy, and Jumia, all in the same industry as Baba. And if Baba has a number in green, they're better than the average. If they have a number in red, they're worse than the average. They're a little better in PE ratio at 31, average is 33.4. They're a little worse in price to sales ratio, a little better in price to book. So even though I said their ratios are not so great relative to the entire market, you should always compare ratios against companies in the same industry. Their current ratio is fine at 1.9. Their ROE is a little worse than average. They're 17%, average is 22%. They have a really low debt load at 14%, average is 43%. And they're a massive company, 601 billion market cap. A lot smaller than Amazon, but still a massive company. And they don't pay a dividend. Most companies in this industry do not pay a dividend. So to summarize, I do have them trading at an 18% discount because I'm basing their future cash flows off of their growth from the past. But this antitrust situation throws a monkey wrench into their business model, so we don't really know what's going to happen. So it can be risky investing in the stock, or you may get a great return. No one really knows. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.